Welcome to the first live Q&A. I'm going to be answering some questions, and the goal of this is to make sure that at least you learn one thing out of today's live stream. So it'll take about an hour, depending on how many people will show up. So Da asks a question here. Which crypto do I think will do the best over the next 5 years? I think it's either going to be Ethereum or Bitcoin. I don't know which one is going to do particularly better over the next 5 years. I have a little bit of both. I have more Bitcoin than Ethereum right now, but it's hard to say. It's going to depend a lot on Web 3.0 and how much people adopt the Ethereum technology and build on top of that. Um, to me, Ethereum is more of a wild card. So there is more of a, if it does do better over time, it's going to do a lot better. And if it, doesn't do well, then I think Bitcoin is going to be the winner there. Okay, so having some new people in here. Thanks everybody for joining. Sorry we are an hour late. I had some technical difficulties there, but it's great to see you all here. If you have any questions, leave them in the chat and I will be getting to them. But first, what I wanted to do was go over the various questions that I got from the community channels. And if you asked a question in the community channel over the last week since I posted that, then we will be going over that first today. Not in any particular order, but if you had something in there, then we'll definitely take a look at that. So that is going to be from this one over here. Just going to take a look at this. So if you don't know already, I post almost weekly, pretty much weekly on the community channel. And then so the last one was just asking you, what kind of questions you want me to answer today. So that's what we're going to go over first. And then afterwards, I will be taking your questions in the live chat so that we can go over whatever topics you want to talk about. And then hopefully give you some guidance and give you some informed information that you can make so you can make better investment decisions or financial decisions on your own, wherever direction you want to take with your money. So the first question I am going to bring up here is going to be from Vladitas. And basically the question is, what made you start YouTube, and are you planning to expand content in the future? So that's a great question, I think, to start, because maybe a lot of people are wondering like why I decided to go on YouTube. Well, as some of you know, I have a blog, Freedom 35 blog, and what happened was when I reached financial independence in 2020, I put out a poll and I asked, hey, what do you guys want to see me do next? Like besides just running the blog and posting once a week, what other content, should I make that will you think will be valuable, right? So the most highest selection was to create online videos here about money. So that's why I decided to start a YouTube channel. This was about a year and a half ago that I put this post out. The second most picked answer was to record a podcast series with 77 votes. So that's something I can do as well. I'm not so certain about that right now. I'm still working full time, so it's kind of hard to find the time there to do that. But I do like making videos, so I will continue to do this once a week, as well as make blog posts. And second part of the question, did you ever consider starting a podcast with my wife or with my friends or other people? Yeah, so that's something I can definitely look into maybe not right now, but in the future, if somebody wants to partner with me to do like a regular podcast series, that's great. I think YouTube is actually a really good media for uh, doing podcasts as well. A lot of times I just treat YouTube videos like a podcast, especially if, because a lot of people put their podcasts on YouTube, but also if they're just talking in front of a screen and there's not really a lot of visuals to show, then I think a podcast would be definitely, uh, uh, you can listen to YouTube as a podcast. You can just set your phone down, or you can listen to it on the computer. So I think it works out that way. I do have YouTube Premium, so I'm lucky enough to just close my phone, but the video will continue to play. I think it's one of the better investments that I've made, having YouTube Premium. So yeah, great question. That's why I decided to make YouTube. I think it's a nice um, pair with the blog, because on my blog I can talk about more strategic or technical topics, and then on YouTube I can sort of delineate that more and then maybe show with visuals and audio cues like how that might work. So I'll definitely continue doing that. The next question here is from Mo. Hey Mo. Mo is we've known each other for a while. He has a great channel as well. You can go check him out at Momentum Finance. So Mo is asking, first of all, what's the biggest lesson that I've learned investing in the real estate market? The biggest lesson to really, for me, is to understand where my biases are, to understand where my uh, shortfalls are, and to overcome them, and then to be better at investing. So one of the most common myths out there is that you can't do better at picking stocks over time if you learn more about it, which I don't think is true. I've been investing in stocks for the last 12 years. I sucked at picking stocks 12 years ago. I'm better at picking stocks now, picking quality stocks, picking stocks that go up over time, making sure I have my emotions in check and I invest rationally and not emotionally. 12 years from now, I expect to be even better because I'm always learning more. I want to keep getting better at picking stocks. And I do believe that there is a strategy you can use that you can pick better stocks than the overall market. It's a constant process, so I'm constantly learning more. But we do have, evidence of, great investors who have outperformed the market, got 20% return on average over like 20, 30 years. And, success leaves clues. So I learn from those investors. I learn how I'm different in investing compared to them, and how I wanted to bridge that gap or to make myself more of a better stock picker, right? So going through that process is one of the best learning experience that I have. And it's really just about experience and time and exposure and being patient with yourself and knowing that you're going to make mistakes. But overall, it's so much better to learn about how to invest in the stock market. You're going to have more fun, at least I think so. And you also feel more connected with the world around you, with the economy, with the financial markets. And I think, one of the biggest benefits about, I guess, investing in individual stocks, if you have the time for it, is you sort of like understand the world in a different way. You can respect businesses and companies from a perspective of their finances, of investing in them, and how they're all like interconnected with the world. So it's going to keep you more informed that way. I think that's definitely one of the biggest benefits for me when it comes to investing. So the second question is, since you have various different investments, which is your favorite? Yeah, so that's a good question. There's no favorite investment class at all times, but depending on what is currently like a good value proposition, then I will invest in that. So for example, this is a chart put out by a banking study, and it shows that the average investor over the last 20 years or so has gotten only 2.9% return per year. But the S&P 500 is 7.5%, and then all the way to the left we have REITs, which are real estate investment trusts. Now, personally, I would say the best investment, just in general, I would say it would be stocks. Now, Mo mentioned a lot of other different asset classes here, like crypto, precious metal, farmland. I think all of those have their potential upside as well. But I think if I had to pick just one favorite investment asset class to choose, it'd probably be stocks. Because if you look at the S&P 500, the small cap stock index, emerging markets, equity, as well as developed markets, and you just like combine those and get an average, you're going to look at like 7 to 10% return on average a year over from 2001 to 2020. And that's because historically stocks, which are basically just businesses, have a tendency to grow their earnings and to have purchasing power and to, over the long run, basically not be affected by inflation as much as some of the other asset classes like bonds. Homes, I'm surprised homes is so low on this chart. I'm not sure why. I think it's because they don't include the implied rent or the value that you get from like living in your own home, right? But I think this is only for investment purposes. However, if you buy a home and you live in it, then it's going to give you more value than just what the investment returns would be, because there's the cash investment return, and then there's also lifestyle benefits and emotional benefits and other returns that you can get that is not directly specific measured by money. So yeah, definitely if you're starting out investing and you're looking at, which of these different investment I should go for, because there's peer-to-peer lending, there's real estate, farmland, and you don't have a lot of money to start, I would certainly just look at stocks. I think that's one of the best investments anybody can make. And with broad market ETFs, it's so easy to just buy a general diversified portfolio of stocks using a low index fund, a low cost index fund, basically. Okay, moving on to the next question by Potato. Hey, Potato, hope you're doing well. The question is, so she's looking to buy a second property, congratulations, over the next 5 years. That's good. I think there is an opportunity for you to buy over the next 5 years. It just might not be right away, and I'll explain why in a bit. So besides analyzing sales to active listing ratio, what other indicators can we look for to see if there's any good deals, right? And that's a great question. Real estate is probably going to be one of the biggest investments you're ever going to make. So it's important to look at where the trend is going to make sure you're not buying at the top, or you're not buying at a where it's near the top and you have to compete with other people to buy it, basically. So the sales to active listing ratio is one of the most important, because she mentions here that is a ratio you have to analyze. That's one of the most important ones. But the other ones, there are two other indicators that I would look at. One of them is the sales. Sorry, that's the sales to active. One of them is the months of inventory. This is courtesy of Steve Saretsky, local real estate, local realtor in Vancouver here. And what this chart looks at is how many months of listings there are if current homes are being bought at the current rate. So as you can see right now, it's below 2 months, which means if all the new listings were to just stop, like if nobody from now on listed their homes for sale, it would take less than 2 months. That looks like almost like 1 month for the inventory to just clear out, right? So that basically means, for example, there are 10 listings on the market right now. This is for the greater Vancouver area. So if you live in different cities, this is going to be very different for you, or different countries. So right now it looks like there's something like, for example, there's 10 listings on the market right now, let's say. There's probably thousands, but let's say there's 10. And right now the sales rate is 10 sales per month. So that is a very low months of inventory. And what this means is there's not a lot of choices for buyers, because there's not a lot of sellers out there listing their homes. So if you're in the market to buy right now, you're basically going to have to compete for the low number of inventory out there. I would probably not look at buying, particularly in the Vancouver market, unless the month of inventory is above 6 months. Because if it's above 6 months, like we had in 2019, 2020, then that means you have more of a choice when you go out and look for homes, because there's a lot of inventory out there. And that means you have more price negotiating power, right? So you can basically not have any bidding wars, hopefully, because why does everybody have to go after the same property when there are so many other properties out there? So this is one thing I would look at. And what this is showing me right now is definitely not a good time to buy. Now, that doesn't mean if you don't have a home and you want a home, you shouldn't buy it, right? Because there are other elements that you can look at besides just the monetary value of it. Um, if you were to buy a home now in Vancouver, 10 years later, you're pretty much going to be higher. It's going to be worth more than what you have now. Plus, you don't have to pay rent all those years, and you're working down your mortgage. And over the next 10 years, people who are paying rent, who decide to not buy, their rent's going to be a lot higher than it is today, most likely. So the question isn't, is buying a home right now going to make you money in the future? It likely will. The question is more like, can you put your money in something better than real estate over the next 10 years that's going to provide even more return, right? So it's all about that opportunity cost. So month of inventory is one thing I would look at. And another thing I would look at is year over year changes to condo prices. And this is just for condo prices, but you can also look at it for other types of real estate as well. Yeah, so definitely one of the things to look for in terms of price is not just the price itself, but also the change in price. And that is what basically this chart tells you. So in, for example, 2009, the change in price was minus 10%. So prices actually dropped, which doesn't happen very often. You can see that only happened from 2009 until now, just a few times. So this is a good chart to look for when you're looking for indications of when to buy a home. Because if we look at, basically anytime where you have a large fall, like more than 10%, and you have like a hook that goes back up, that would be a pretty good time to start looking at buying. So for example, that's a big drop and then it goes back up. So right around here, that's an indication of maybe I should start looking at buying into the market. So that was in 2009, which would have been a great time to buy. Here, another one, it's gone down by more than 10%. It even fell negative, and that just means year over year prices did go negative just a little bit, and then it went back up. So that would be like another indication to maybe look at something to buy. At this one, it didn't fall as hard, so I probably not put too much emphasis on that one. This one fell, but again, not so much. This is a huge fall, so probably like a once in a decade opportunity there to buy something. And again, this reflects back to that other chart we were looking at, which is right now this is going up, and it's probably not a good time to buy, because unless it does this, that would be a good time to buy, right? Or it doesn't even have to fall that low. If it falls by like 20%, so right now it's at like maybe 17, 18, which just means the most recent data is year over year, real estate prices in Vancouver are 17, 18% higher now than they were a year ago. If it falls back to zero, which means there's no change, and it starts doing this, that would be an indication to me to start looking at something to buy in the market. And you'll also see other data corroborated with this. Like you'll see month of inventory rise when this thing happens over here, because when you have high number of homes listed for sale, not a lot of buyers, that's going to put downward pressure on prices. So that's something I would certainly look at. So what's the other part of the question here? Yeah, so those are the couple of indicators I would look at, and also curious to know my real estate predictions for Vancouver and the surrounding areas next year. Yeah, so that's going to be dependent a lot on what the Bank of Canada is going to do. But what's happening now is, like, over the last few years, there has been a lot of people buying homes, and these would be like the buyers, right? And most of these are well capitalized. They are not going to run into issues if interest rate go up like 1 or 2%, because they have what it takes to um, basically withstand a lot of market volatility. However, there are like a small proportion of this, maybe like 10% or something. I'm not sure, 5%, 10%, and these would be high risk borrowers, and they're in the market right now. And when interest rates go up 1 or 2%, they have to be forced to basically sell their home or do something else because they don't have the capital or the purchasing power, the saving power to really accommodate for that. So they're going to put their homes uh, on the market. So inventory is going to go up. And when that happens, it's going to put downward pressure on prices. So over the next 2 or 3 quarters, I think that's what's going to happen. But there aren't a lot of people sort of in this category. So the biggest thing right now is to look at what the factors are to contribute to these. You might get a peak, like a rise in inventory, but that I think is going to be quickly bought up by people who are in the market who are looking to buy homes. So I think what's going to happen is let's say this is 2022, 23, 2024. Right now, in the beginning of the year, we're seeing like prices. This is prices. It's gone up a little bit and it's pretty much flat, maybe down a little bit. It's either going to, for the next couple of years, it's either going to go down and then go back up like that. This is maybe down like 5%. It won't be down too much, or it's going to go flat and slowly rising back up like that. So how this is going to play out is going to depend on what the Bank of Canada does. Right now, the Bank of Canada, the Bank of Canada is raised rates already 0.5%, the recent one. If it follows this red line up here, which is raising another by 100 basis points, then we are going to see basically this line here, because interest rates will be rising too much and a lot of people are going to be dumping their homes, and that's going to put downward pressure on prices. So we might see a small drop in prices. However, if the Bank of Canada, this one here, raises rates slowly, 25% at a time for the next like year and a half, then that's going to be a more gradual increase. And I think we're going to see this second line up here, which is that prices don't actually fall, they just go flat. And I think that's definitely more of a possibility than this down. But somewhere there, I think, is going to be the likely scenario, either down 5% or just flat, and then go up again in 2023, and then further higher in 2024. So one thing to keep in mind is, like, why, if the interest rate goes up, why don't prices fall? At least in the Vancouver area, and that's because of mostly immigration in Vancouver. This is from Vancouver is Awesome, this website, and the reason Vancouver is awesome is because I guess a lot of people want to come here. In 2021, last year, BC had over 100,000 people come into the province, and it's not just from outside of the country. 33,000 of this 100,000, so about 1/3, actually came from other provinces. So it's not just BC is attracting people from around the world, but it's also attracting Canadians from other provinces. So is this going to stop anytime soon? Probably not. Looking at the Government of Canada website, we're going to get 431,000 immigrants into the country this year. a little bit more the next year, and then even more the following year. So what is that going to look like? Well, if we take a look at last year's numbers, 401 people came into Canada, so a little bit less than what we're expecting this year. 17% of those people immigrated to BC, right? So this year, I would expect, if the numbers, are fairly consistent, another 100,000 people to come into BC in 2022. And I would say at least half of those people are going to come into the Lower Mainland. So you're looking at like at least 50,000 people coming into the Greater Vancouver area this year, next year, the following year. And we don't have enough supply, new supply, to really, cover all of those people's housing needs and still have prices, you know, like, and have prices be affordable, or to have prices go down. So I think that's going to be a major contributing factor to what keeps prices higher. Is basically immigration is going to go up, and that's what's going to prevent prices from going down. But again, it depends on how quickly the Bank of Canada changes that. Their tightens monetary policy and changes their interest rates. So all that is to say, I think prices in 2023 are either going to go flat or they're going to go higher. It's not going to go 20% higher like we saw in the last year. It might go like 10% higher by 2023, and then another 10% growth in 2024, simply because we have a lot of people coming into the country and also to the Lower Mainland. Next question here is from Stephen, and he asks, what are my thoughts on the real estate market in Canada? Yep, so we just sort of went over that. If interest rates climb by, so June is the next rate announcement. If it goes up by 0.5 and then the following announcement goes up by 0.5, we're looking at 2% on the Bank of Canada interest rate. We're probably going to see that like 5% drop in real estate prices as we get to the end of the year. But if we go slower than that, then prices might be flat. And that's across the Lower Mainland, but I think it'll also be reflected in other large cities like Toronto and Ottawa. For places like Calgary, where there's a lot more like spread, you have urban sprawl and you have more places to build, I think prices might come down more if they do. So you might see like a 10% drop, for example, if interest rates go up really high. It just depends on where you live. Favorite rental areas? That's a good question. I'm going to go to PadMapper, which is a website to look for rental income. And before, like 2 years ago, maybe even 1 year ago, for $2,500, you could get a 1-bedroom in downtown. But now, so this is downtown Vancouver, this little island here. But now, even outside of downtown, I'm looking at Mount Pleasant, which is just south of the Falls Creek. And, $2,800 for a 1-bedroom, right? So the rent price is going up. And what that means is the people who basically bought here a couple of years ago are making pretty good cap rate on their investments. 2,500 for this one here, a 1-bedroom. This one looks pretty new and clean. So before, it's like you should get into the downtown market if you want to, have high rents, if you want good rental income. But now, even if you're outside of this like city center core area, even out here, you're still sort of in Mount Pleasant, but you're a little bit further away from downtown. A 1-bedroom will set you back $2,300 a month. So I think anywhere around here where you can't build out anymore, you can only build up, is a good investment opportunity long term. Again, if you're only going to buy something for 2 or 3 years, I would not recommend you buy real estate because the friction costs are really high. But if you're looking for a place to buy, I would say either downtown or around the downtown area. Anywhere nearest the SkyTrain line. So this is up here in the Brentwood area in Burnaby. You can see the rents here. They're not as high as downtown, of course, but they're still pretty good. But you're not paying, like a high amount of capital in order to buy these compared to downtown, unless you're buying something new, and then you're probably paying like 1,300, 1,400 square feet for these. Yeah, this one's pretty high, 2,900. Probably a really good view up there from that one. this is a 2-bedroom. So for a 2-bedroom in Vancouver now, you're looking at about $3,100 for rent, which is uh, unthinkable even just 5 years ago. So unfortunately, I think rents are going to continue going up, which is not good if you're a long-term renter, which is why I would consider buying if you don't already have a place if you live in like a major city. So yeah, anywhere where you have population growth or near fast transit system is good. Am I eyeing any future purchases right now? Not at the moment. So I'm keeping an eye out for opportunities, but I'm not actively searching for real estate properties to buy. And the reason is because uh, we were looking at the uh, like active sales to listing ratio, and it just it doesn't feel like it's a very good time to buy right now. It's like over zero point 0.6, which is over 60%. Also, for those of you who might not be familiar with this, let me just explain. So this ratio basically takes how many homes are being sold, compare that to how many listings are currently out there. And what this tells you is how fast homes are being sold relative to the size of the market, how much you can buy. If this is below 12%, then that means it's a buyer's market. There's not a lot of buyers in the market, and there's a lot of people selling their homes. So back in February 2019, this was the situation for detached homes. There weren't a lot of buyers basically, but a lot of people were trying to sell their homes. So in 2019, it would have been a good time to buy. Townhomes at that time was at 15%, which is a balanced market. And anytime over 20%, not in this case, but if you have a 20% sales to active listing ratio or higher, then that would make it a seller's market. Right now, it is a seller's market, as we saw with that chart here. It's over 60%. But again, this is for the entire region, and you have to look at the individual neighborhoods in order to get a good idea of what is going on. So I'm going to open up this Snap Stats information. If you live in the Greater Vancouver area, I would recommend you getting this. You can get it from any realtor. You just call up your realtor and say like, hey, I would like the Snap Stats information posted monthly. If you don't have a realtor, you can just ask me, and then I'll give you some references for that. But basically, this shows you for last month, West Vancouver, what the sales ratios were for the different neighborhoods. So there's not a lot of data here for certain neighborhoods because certain neighborhoods don't have a lot of listings usually. But if we go up to West Vancouver for detached houses, you can see there are some information here. So we have inventory, sales, and then the sales ratio. So generally, we're looking at this. The sales to active ratio is above 60%. But what if we dig a little bit deeper and look at individual neighborhoods? So in this case, West Vancouver, you can see the sales ratios are all over the place. So it's not that if the sales ratio are high in general, which they are right now, there aren't any opportunities. It's that you have to look closer and sort of peel back the layers and look at specific areas, right? Because real estate is all about location, and you have to get specific with your location. For example, with the Altamount neighborhood, we had 14 listings, but only one of them sold last month. So that's a sales ratio of 7. So that's a buyer's market in that particular area. Chartwell, 7%. So like, I don't know why. I don't research West Vancouver all that often, but for some reason, there's not a lot of interest for people who are buying in that area. Now, it might be because like that's just really expensive in West Vancouver for detached houses, and there's not a lot of people, willing to spend money or have the means to buy in that neighborhood. But what this tells you, at least, is there's a lot of opportunity for you to negotiate in price, and you also have options. Like you're probably not going to run into any bidding wars, at least in this area, right? But of course, in other neighborhoods like Furry Creek, there were only two listings, and one of them got sold. So you have a really high ratio. Even like Glenmore, a lot of listings, 4 got sold. So you have a ratio of 36. So 36 would be a seller's market at that point. Um, but a lot of it is just based on timing and how that goes. So that's something to keep in mind. Is this is a good guide, like all of these charts, month of inventory, like I just talked about. This is a good indication that maybe now is not a good time. So I would probably not be looking at buying until we get to about this goes back up, and then we at least get to like 6. That would be like a good line to look at. However, that doesn't mean you're not going to get a good opportunity to buy something if something really good comes up in a specific neighborhood that is outside of the norm. So that's why I like to keep an eye on things. But at this time, like I said earlier, I'm not looking to buy any new real estate for myself. Um, would I be purchasing an entire building? Not at this time. Maybe in the future, if I have some other partners I want to go in with, buy a whole building. That would be pretty cool. Thoughts on REITs? Um, yeah, I like REITs. I think they're really great for investing in real estate if you don't have, or if you're not ready, or if you don't have the means yet to buy a property downright. So if we look at, some of the REITs I have just on my blog, I post all of my current positions. So I keep my REITs mostly in my TFSA and in my RSP for the tax benefits. I have this one here is an American one. Um, uh, Annually, it's done okay, but it's not done great. Like I'm still up on this because it paid so much distribution over time. Automotive REIT is a really good REIT. I bought it last year, 2021, and it's gone up quite a bit from 11 to 14 so far. So that's a pretty good REIT that I like. Boardwalk REIT, also okay. I've had RioCan for a long time, but obviously not the best REIT to own during the pandemic because they uh, own a lot of shopping centers and they rent to people like, or to companies like Walmart and other large businesses. Uh, so another good REIT that I like right now is Canadian Apartment Properties. You can see it's gone up a lot over the last, let's say, 5 years. Yeah, so it went from like $32 to $51 over the last 5 years. Plus, it's got a distribution of about like 2.8% or something. So it's a pretty good company overall. And what this REIT does is it invests in companies, or it invests in residential properties, and it puts people in there, and it collects rent. So I was just saying how I think rents are going to go up across Canada, especially in the major cities, and that is going to be a nice tailwind for REITs that invest in apartments, basically. So CarUN is a REIT that I currently have. I think it's in my TFSA, and I think it's worth looking at if you're new into REITs. Those are just some ideas of the REITs I have. You don't have to invest in obviously anything I'm invested in because I don't give individual advice. But if you're wondering like where to get started in terms of research, those are just some ideas that I have. Okay, so yeah, so REITs are definitely good without the headache of managing your own property, right? I'm just going to take a look at the comments here. So if you are just joining us, well, thank you for coming. This is the first live stream, and I'm just answering some Q&A questions from the audience here. I'm starting out with the questions that's already on my YouTube channel, and then I'll get into the chat afterwards. So what type of, this is from V. Thanks for the question. What type of trading tools do I use? Is there anything else like passive? I don't really use any third-party trading tools like passive. I don't use robo-advisors or anything. So I use interactive brokers and I use TD to do most of my trades. I don't know if there's anything similar to passive. Yeah, at least in Canada or even the US, I think they are a pretty niche company that has like a good service for a specific type of investors. And what passive does, I think, is they basically automate your rebalancing and tells you what you can do, so you can do it all fairly easily. But that's not something that I'm too familiar with. And I don't know if they have any competitors. But I just trade old school. Like I look at a stock, I think I like it, and I buy it. What do I think of split funds? I don't really like them personally, just because I don't think there's really any value added for investors. Um, when a split fund, when you buy a split fund, you basically invest in a company that is split. So you have some preferred shares, and then you have like a dividend. So the dividend gets paid in the preferred shares, and then you have another class of shares that basically gets any upside or downside if the company makes money. The thing is, there is a management fee for I think it's Class A shares. So I would rather just look at a company by itself. It makes investing easier, I think, to just buy individual companies. Split funds are good for certain investors if you're looking for income and they're not looking for, potential upside gain on capital gains. So that's something that might be interested, that some investors might be interested in, but it's not something I'm looking at right now. Yeah. So what other types of strategies can you use for income? Still, split funds. If you buy the preferred shares of that, you can get dividend income for that. Uh, I kind of want to see more institutional investors buy split funds. I think right now a lot of those funds are small. A lot of those funds, they don't have a lot of volume. But if there were more interest from institutional investors, I think that would be a better opportunity for retail to also jump in. REITs, we just talked about, is another good income driven investment that you can invest in, particularly if you're renting. You can buy some REITs to hedge against rising rental costs, right? Because if you're renting for the next 5 years and real estate price goes up over the next 5 years, which I think it will, then at least your REITs, because they're charging more for rent and everything, and the value of the underlying real estate they own has probably also gone up. So you're going to be making money from REITs, and then as the distribution of the REITs get higher, you can use that to offset the cost of higher rent that you're paying. So that's a good way to use REITs. They provide income. Preferred shares also provide income. Dividend stocks, of course, maybe with an emphasis on dividend growth stocks, they would provide really good income. So yeah, lots of different options out there. It just depends on what you are looking to buy. Personally, I used to focus on income quite a bit, like looking at which stocks give the best dividend growth or which REITs give the best distribution. Uh, but over time, I've found that it's the total returns that ultimately count, and it's your cost of capital and figuring out where's the best place to put your money so that you're basically minimizing your opportunity cost in other areas. Okay, so I think that was the last question on the YouTube channel. Yes, cool. So I'm going to just take a look at the chat here. And yeah, so a lot of new people are joining. Hello, Syed. Nice to see you here. So Liam asks, do I think Russia, it's being cut off a little bit here, but do I think Russia pricing food and energy in rubles will undermine the US hegemony? And will the currency collapse as a result? Or will interest rates rise? Yeah, that's an interesting question. I think it could go either way, but I don't think the US dollar is going to, collapse anytime soon. I think the ruble will go lower because of what's happening. It depends. I think it depends on what China's going to do with Russia and how that partnership will play out. Because if they wanted to, they could really put pressure on the U.S. dollar and make it less valuable because they can have their own economy and trade set up without using U.S. dollars. That's one potential. At the moment, I still think there is a lot of demand for U.S. dollars, so I don't think the US dollar is it's going to go down, I think, over the next couple of years. It's going to lose some value, but I don't think it's going to be like a disaster. It's going to be a slow moving thing because it's not just like the US dollar that's printing uh, uh, a lot. It's the entire world, right? So central bankers move in unison with each other. They don't think independently anymore. I think the US interest rate will go up, but it won't go up, like a lot. And I think that's going to be the same with other countries. So we're still going to get some level of stability, at least for the time being. Of course, things could always change really quickly. Uh, but yeah, at this time, I don't see the uh, conflict causing too much issue with the US dollar hegemony in the world. It may cause a lot of inflation in the meantime, especially with commodities like energy and food prices. But I also think that is uh, going to be uh, short-lived, and it's not going to continue on. Jay asks, what is my opinion on BLK right now? I mean, BLK has gone down a lot since the beginning of the year. And I think it's actually fairly valued now. If you look at the PE ratio, it is at 17 times, which I think is below its historical average. I think it's like 19 times or something over the last 5 years. So it is a really good stock. Like, it has really strong fundamentals, so I like it. And it's also at a decent value. Like, it's not cheap. Um, it's not like 15 or anything. But all you're doing if you're buying this now is you're just buying uh, future growth of the company. So I think it's okay to, if you don't have a position yet, to start a position in BlackRock. And the way I'm getting in is with selling put options against it, of course. But yeah, I don't think it is a company that is going to drop significantly, even if we see a like a bear market in the S&P 500. I think BlackRock is pretty much like the most drop has already happened with BlackRock. I think because it's such a strong company. Like, I don't think it'll go back down to pre-pandemic levels, just because it's making so much more money now than um, what it was making before. So I can easily see this going back up to 800 by the end of the year, depending on how the rest of the stock market does. And that's the thing, you sort of want to um, really separate out. I think um, yeah. So one of the questions I kind of just skipped over this, but I'm going to come back to this now. Is what trading advice would I give to somebody who's a college student, right? So it's interesting that Vadidas asked trading advice and not investment advice. So I just want to give people an idea of like how I sort of see the separation of the two. So when you're talking about trading, you want to have a different mindset than when you're thinking about long-term investing. So over here, you might have, so this would be like your trading stocks. And then over here, you might have your investing stocks, and you want to keep them separate. In your trading category are stocks that you think might go up, and they might go back down again. So there's a range of movement there that you can basically trade in and out of, and those would be like your cyclical stocks or your pandemic stocks, like a Peloton or like a Zoom. Also for energy stocks would probably go into this category. Your investment stocks would be stocks that you believe in long-term growth, and you do not want to trade in and out of those, because chances are you're not going to get the timing right. But for trading stocks, you could actually time it by looking at technical analysis, which I think is uh, another good point for this question here is what is a good trading advice? I think a good suggestion I would make is really understand technical analysis and how the charts move, and understand momentum. That's going to help you with trading for sure, right? So going back to yeah, this here. So your investment stocks, I would put BlackRock in here. I would also put like a Google. Those are, and also like a Microsoft or Apple, because those are companies that I could hold for 20 years, and I think they're going to be much higher than than they are today. Whereas trading stocks would be like you can put like meme stocks in here, but I would put more stocks with more volume. And so pandemic stocks would be one example, but also energy stocks. Like oil prices have gone up a lot, but oil is not going to stay up this high forever. Eventually it will, I think it will crash again. I don't know if it's the next month or the next 2 years, but that would probably be a time, if you are considering trading energy companies, to probably get out there. So have the two separate in your mind so you don't conflate the two. And I think that's how you can become um, a better trader when you're starting out, at least. Yeah, because it's very easy to think about investing all as like one category, but if you're particularly thinking about trading, then um, you want to have a sort of a different mindset and look at more technical, and basically take your emotions out of it and really set your stop losses. When you're investing, you don't set stop losses. If a company drops like BlackRock has done, and it's like down to 662, and it's an investment for you, you buy it. If it goes down to 600, you don't sell it, or you don't have a stop loss at like 620. You just buy more at 600 because it's a good company. Um, and also you have to look at the reason, right? Like the reason BlackRock has gone down over the last few months is not because the company is hurting. It's just because the overall market is down because of what largely because of what the central banks are doing um, around the world, particularly in the US. So so that is a good question, and sort of leads to my thoughts about what kind of um, stocks I would consider as investment compared to trading. Andrew asks, what do I think about farmland, right, as an investment, as a first investment? Okay, so yeah, so I did own a farmland before, and I did sell it a couple years ago. Would I do it again? Right now, I would probably not. Probably because I don't live close enough to a farmland to really manage it myself. So I would probably hire some other company. But in that case, I might as well just like buy a farmland fund or something. But right now, I'm not really interested in farmland investing. Just looking across Canada, I think the major movement of farmland has already happened, like the major move up. So I would probably wait and just to look at it and see if it goes down, if there is a buying opportunity. But right now, I think there are better opportunities in the stock market, in growth stocks, in a lot of technology stocks that I think are going to bounce back up. So I would not be investing in farmland at this point. Of course, it's all just like with real estate. Farmland is very specific to location. So if there is a good deal nearby and I understand the like local economy and everything, then that's something I can look at. But right now, I'm not actively looking to buy farmland again. Thank you, Andrew. Big fan of the blog. Yeah, it's nice to see a lot of people from my blog also coming here to join the uh, live stream here. Another question here. This is from Syed. How do you use margin or margin ratios, and how do you keep your leverage ratio in check? Right, so you don't get margin called. Right, so that's a great question. I think you brought this up before in our impromptu stream earlier. So the way I look at margin is I think about it in terms of how much liquidity I have left, and then based on that, I would use the market sentiment to really calculate how much room I have before I need to put liquidity into my account again. So, for example, this was my Interactive Brokers account on, I forgot when exactly this was. It was from like recently. And you can see during the day, I was down $22,000. So that's not a good place to be in. However, the main thing I'm looking here is excess liquidity. And if this thing falls below like 50,000, which it is now because it went down a lot during that day, then that tells me I should probably put more money in here, because it means if the portfolio that I have goes down by another 33, or goes down by $33,000, then I would basically get forced liquidation. So because I don't want that to happen, I would take money from my HELOC, my home equity line of credit, and I would put it into the stock market, or into my brokerage account. And that way it'll sort of increase this excess liquidity again back up to over 50,000. So I don't have that risk of getting margin called or getting my stocks sold. So that's something that I have to keep an eye on. Now, if I get the excess liquidity to over like 100,000, then I don't have to, watch it like all the time. But right now, I'm getting pretty close to that area. So, so that's how I kind of look at it, and how I kind of keep my account well capitalized to make sure I don't, run into any problems with that. Yeah. So the thing with investing is you have to be willing to uh, have high conviction on your intentions and buy even when other people are not buying something. So that's sort of a lesson that you have to learn over time, is do you have good judgment on the investments you have? And that's only going to come through experience. So uh, I think going back to like most questions, what's one of the major things you learned about investing in stocks is you do tend to get better over time, but not only at picking stocks, but also at knowing your own personal like personality and how you look at the stock market. So I think all of that is really important. Yeah. So I think another question somebody was asking, going back to my channel here. Uh, Stephen asked another question. It's a little hard to read here, so I'm just going to read it. Um, do I use the Smith maneuver, and what are my thoughts on it? And uh, have I looked at private equity platforms? I don't think I'm going to answer the second question first. I haven't looked at private equity platforms recently, but I have in the past. It's kind of complicated to get into that, so I have not bought any private equity investments personally. Usually, they require you to be an accredited investor. You need to have a lot of money. I just haven't really saw any investments that gave me a risk to reward ratio that I thought was worth it, is basically the simple answer there. And have I used the Smith maneuver? I'm not using this Smith maneuver right now, and I haven't used it before, but I do use my HELOC. Like when my Interactive Brokers account got to like 30,000 left of liquidity, what I did was I basically took 10,000 from my HELOC and put it into my account, so that way I can capitalize it again. Yeah, so that's definitely something to look at, is the Smith maneuver for me. I've talked to different people who've done that. John and Christine from Fire We Go, they use the Smith maneuver, and it's been working well for them. So, possibly that is something that I can do, but just not at this moment. Yeah. So, yeah, there's still. I think we got more people here now, which is great to see. Currently at 12 concurrent viewers. Yeah, I apologize again for starting late. I was having some issues with the stream, but this will go on YouTube as a standalone video, so you can always check this out later. Yeah, if you have any other questions, feel free to leave them in the chat. And one thing I would just maybe end off on is to really try to understand how you as an investor will behave when the market crashes, because it's one thing to gain more profit as the stock market rises, and that's all good. But when we have a 20% drop like in a Nasdaq we're seeing now, how are you feeling about it, right? Like, are you comfortable with it right now? And if you are, what are your plans going forward? Are you buying more? Are you taking some, risk off the table to maybe put in cash because you think it might fall further? Uh, there are different ways that you can, play the market. But I think if you're a long-term investor, really focus on where you see your money going 10 years from now, and uh, where is the best place that you can, allocate your resources so that you're minimizing your regret, right? So if the stock market is going to go up a lot in the next 5 or 10 years and you're sitting on the side, is that really the best place for you to be? Um, yeah, I'm not sure. So that's definitely a question you have to ask yourself. One of the things that just came out, it's a study that I saw, and it basically looked at what personality type you can have if you're looking to, um, or what are some of the traits that millionaires share, which I think is kind of interesting. So that is from Nature website, or yeah, the nature.com website. And they basically had a study looking at millionaires and non-millionaires, and what they found was that uh, so high wealth was associated with higher risk tolerance, emotional stability, which is low in neuroticism, and high openness and high extroversion. Extroversion just means extroverted, and conscientiousness, which is how like industrious and hardworking you are. If you're an employer and you're hiring people, you want to hire people with high conscientiousness because those are the people that you can depend on. They, do work diligently and they don't mess about. So if you have that and you have extroversion, more openness, lower neuroticism, which is the tendency to be very sensitive to negative emotions like fear and anxiety, and you have a higher risk tolerance, then you will be likely to have, I mean, it's a correlation, so I don't know about causation, but you are correlated to have more money than the average person. So if I go to the conclusion, uh, yeah, so the prototypical personality profile of somebody who is rich is marked by these things. And if you want a chart, I think they have a chart here uh, that they show. So we can take a look at this one. Risk tolerance. So the pink line, the pink curve is for rich people. And then the black line is the typical non-rich person. So this is what the study showed, is that if you have higher risk tolerance, um, then you are more correlated to have higher wealth. Neuroticism lower, so that means you're more emotionally stable. Openness is just an openness to, like, you're open to new experience. You don't mind change, right? So I think that's definitely one of the most important things about, if you want to become a better investor, you need to be higher in openness because things are changing all the time. And if you have an outdated philosophy about finance and investing, it might not work in the new world that we're living in, because the economy is always changing and you need to have new ideas to figure out how to move forward. Conscientiousness, I'm surprised it's not a bigger determining factor, but you do see a benefit from being slightly higher in conscientiousness, um, or rather, people who are millionaires have slightly higher conscientiousness. Extroversion, uh, I think this one is a little bit debatable. I think there's some controversy around this. Is, do introverts make more money, or do extroverts build more wealth? Right. So I think in my particular case, I can certainly benefit from being more extroverted because there were certain circumstances in my life where I think being extroverted would have helped me gain an advantage in my career, or just in finance in general, if I was more open to like talking to people, if I was more extroverted. So there's definitely that, and then agreeableness. So being less agreeable will, so that may help to make you build wealth faster, but not by much. I'm going to look at the questions again one last time to make sure if there's anything I've missed here. Was there a... Okay, so do I think stagflation is on the way? This is a question by V. Oh, I actually had my chat set to, instead of live, I had it set to top chat by accident, so I wasn't seeing everything. Okay, so a question by V here is, yeah, do I believe stagflation is on the way? Yeah, I think I might have answered that one. Yeah, I do think stagflation is probably going to be here, and it's going to depend on what central bankers do. Yeah, I think they will let it ride for sure. If like they would rather have stagflation, but they don't want to kill the economy. So they are going to, if push comes to shove, they will lower interest rates. They're more likely to lower rates than to increase rates. Yeah, is your avatar representative of you in real life? Yeah, this is me. I have to, you know, watch like where I go, and I basically have to, uh, clean up after myself because I shed a lot. So sometimes I just have the vacuum nearby because there's just so much hair around me, especially during like now, like during the spring. But luckily I'm a short-haired, short fur bear, so it's not too much of a hassle. Uh, did I miss any other questions? Oh, there it is. Yeah. So there's the question. I was looking for this. Do you believe stagflation is on the way? Yeah. Anyone else saw the video? Yeah. Principles of dealing with the changing world order. That is a great video. I would recommend people check that out. I put the link in the comments so you can take a look at that. Cool. So, do you regret your lending loop investment? Kind of. I regret not taking my money out earlier. I have taken about half my money out, so I might continue to do that, but I might not. So right now in my lending loop, I have I think about like $20,000 left, and out of that like 20,000, about half of it is all gains. So I haven't, basically, yeah. So in the beginning, Lending Loop, which is a peer-to-peer lending platform, I put some money in and I let it grow, and I was making like about 10% a year, which is not bad. But then over time, the non-paying debts were piling up, so there were a lot of defaults, and then I was making like 6% a year, and then now I think I'm down to like 5% a year, which at the current moment doesn't even keep up with inflation. So yeah, I think I do regret a little bit not taking my money out in 2019. I think that would have been a good time because that was when I think there was a lot of non-performing loans started to creep up around that time. Uh, but you you learn, right, and you take the experience so you can do better next time. Now, luckily, I didn't uh, expose myself too much to that. So out of all the money I put into Lending Loop, I've pretty much made like at least half of that back already, and I still have a lot of gains there. But I'm slowly pulling my money out. I used to have around 27,000, and now I'm down to 20,000 because I'm uh, been withdrawing money over time, and I've been putting that into the stock market, which I think can lead to better returns elsewhere. Um, Voters01 asks, uh, I think you live in Canada. Yes, I do live in Canada. So how's my taxes here? Sorry, I'll just reload the comment here. How are filing taxes for your trading income? So trading income is right now taxed as capital gains because I am not like trading as my day job. I sell options like a few times a week, and sometimes more, sometimes less, depending on what the market is doing. But that's more of just a side income thing because I do have a full-time job, although I'm looking to quit pretty soon. So right now, trading income is taxed as either like capital loss or capital gain. However, if you're doing trading as a full-time thing, then it will be taxed as earned income, which is significantly more. So with capital gains tax, you basically take half of your gains and apply that as if it's your full earnings. Tyler asks, how do I position for higher food inflation? So one thing you can do is to invest in companies that provide uh, services or products to the farming industry, such as fertilizer companies like Nutrient. And you can also buy uh, manufacturers of machines that service that industry. Like I've just personally had good experience with Deere. I've owned them for a long time, and they've done very well during these last few years. So that's one way you can hedge against that. Also, if you are fortunate enough to own your own, uh, like a detached house or a duplex or a townhome with a backyard, even a small one, yeah, you can try growing your own food. Just some like easier food to grow, like cucumbers, tomatoes, potatoes, um, stuff like that. It's going to help you save on the cost of food, higher inflation. And another thing you can do, this is what I personally do, is learn to cook any ingredient, right? So the advantage of that is when you go to the supermarket, there are always things on sale, but they rotate the foods that are on sale. So some days it might be like cabbages, and then the next week they'll have like carrots on sale, or they'll have like beef on sale, and then the next week they'll have like chicken on sale. So you can just buy, it's usually produce that are rotated quite regularly. So you can buy whatever is on sale, which will give you like a nice like 20-30% discount right off the regular price. So if 90%, like the majority of what you're buying are things that are on sale, you can just take it home. And there are apps that you can just punch in the ingredients and it'll give you a list of different recipes you can make. But when you do it more and more, it's like with any skill, you become accustomed to the different setups and the different options that you have, and then eventually you'll just be like, oh, okay, I have these things in front of me. I can cook, uh, stir fry tonight, or casserole, or whatever have you. So I find that helps to lower my uh, food prices, and hopefully that's so you can take something out of that for yourself as well. Yeah, it's definitely a problem with higher inflation, though. The good thing is I don't think higher food inflation is here to stay. I think it will go back to like 3 or 4% price appreciation in the future, but maybe like a year from now will go back down. But food, I think it's like 10% now or something. Food and energy is really what's driving inflation, but it's not going to be uh, permanent. Uh, so I think there's some reprieve there. Dixie has a nice comment here. Just buy producers like potash fertilizer companies. Yeah, I agree. That's one way to hedge against rising food costs. V asked, do I hire an accountant? I guess it's to do my taxes. No, I don't. I do my taxes myself. It's not too complicated. I don't have a corporation that I, do fancy income earning through or flow through shares or anything like that. I don't have any estate right now. So that's something that I might look into in the future, but it's just pretty simple. I just have my T4s. I have two jobs, and I don't have any student loans or anything like that anymore. I paid those off a while ago, and then it's just really keeping track of my option trades. And I don't really trade stocks, but if I do have capital gains, I have everything in a spreadsheet. So if I have an accountant, I would be giving that information to my accountant and still having to track everything anyway. So I just do it myself for now. Um, Anil asks, oh, hi, Anil. Good to see you on here. Anil asks, if given a chance to invest in a lump sum versus invest SIP, which one do I prefer? So I guess I would invest lump sum because historically stocks have gone up, and the people who do invest lump sum have a higher return than dollar cost averaging or through like a systematic investment plan. But the problem is everybody's situation is a little bit different, and it really depends on what you think the market will be doing. So if I had a lump sum right now, I would probably put half of it in the market, and I would wait a few months just to see. I think the sentiment in the market right now is not very good. Momentum is down. If you look at the technical indicators, the S&P 500 is probably going to go lower before it goes higher. So because of those reasons, I'm kind of hedging my bets, and I'm putting in like half of my money in now. And what I might also do is maybe buy a really out of the money call option just in case, like for that insurance, that stocks will go up. And then I'll wait a few months, maybe until June, July. And if stock markets are down further, then I would put in the other 50%. So that's what I would do if I had any lump sum right now. I think that makes sense for me. Voter01 asks, when you quit your job and trade for income, what are your plans for taxes then? Create corporate or just do small business self-employed when you file for your taxes? I would probably start off with the self-employed route. I have a small self-employed business income from my farmland. I used to run my farmland through just a small business because I can write off a lot of the expenses there, like interest income and also like any kind of advertising, working with the realtor, things like that. So I'll probably continue to use that and just do self-employed income from then. And yeah, if I do have income mostly from generating from trading, then that will be income. That would be taxed as income. So I would probably just do it myself. Unless things get more complicated, then I will outsource it and maybe hire like a CPA or someone to help me with that. Yeah, Dixie makes a, or sorry, yeah. So Dixie makes a good point about in Canada, if you have a lot of dividend paying companies, then you actually pay lower tax than if you make it from other sources, as long as you're not making a lot of money from other sources. So yeah, that's a good point. It's definitely something to consider. I think once I quit, I will have to re-look at my entire income portfolio, like where the income is coming from, and then maybe do some clean up there to make it more efficient. That's something I'm planning to do anyway. Any time where you're making a large change in your life, I believe that is a good thing to look at is just once in a while, take note of what investments you have. Maybe some companies you bought before you thought were good, and they aren't anymore. So yeah, and yeah, so I think the last thing I will go over is to just thank you guys for coming. It's been running a little bit over time, but I hope you guys enjoyed the live stream. If you're still here and you haven't already, please press the like button. That's going to help get this to more people. Yeah, there's still a lot of people in here, so I'm glad you've all decided to stick around. It's been really fun to have you here. Hopefully we can do this again. And if you have any other questions, just post them in the community tab. You can reach out to me on the blog, anything like that. Have a great rest of your Sunday. Thank you for coming, and happy investing. And I'll talk to you guys in the next one.